If you rewind the clock to the 1980s, you'll find a moment that felt unsettlingly familiar to today. Americans were opening newspapers and seeing story after story about a rising economic rival. Japanese companies were buying iconic US real estate. Japanese cars were outselling Detroit. Japanese electronics were everywhere, often better and cheaper than American brands. And beneath all of it sat a quiet, uncomfortable question. What if the United States was losing control of the system it built? Fast forward to today, and that same anxiety has returned. Only now, China has replaced Japan in the public imagination. But here's the problem with how this story is usually told. Framing it as a trade war, or even a rivalry over exports and deficits, misses what really matters. This is not primarily about who sells more goods. It's about who is allowed to approach the center of global power, and who is gently, methodically kept at the edge. This is where things get interesting, because the most important battles are not being fought on television or at press conferences. They are being fought quietly, through markets, capital flows, technology access, and the rules that decide who can grow fast and who must grow carefully. In public, power struggles look like diplomacy, summits, sanctions, tariffs, tough speeches. But inside financial markets, the same struggle shows up in subtler ways. One country's assets keep rising while another's stagnate. One economy seems permanently cheap, another permanently expensive. Growth doesn't collapse. It just never quite takes off again. And that's not accidental. The United States has never set out to destroy its rivals outright. Doing so would destabilize the very system it benefits from. The real objective has always been more refined. Prevent competitors from becoming alternative centers of gravity. You can grow, you can export, you can innovate, but you cannot get close enough to rewrite the rules. The tools for enforcing this boundary are not bombs or blockades. They are financial plumbing, technology choke points, regulatory standards, and the cost of capital. These tools don't shock the system. They slowly reshape it. If you want to understand what's happening with China today, the clearest guide is Japan in the 1980s. Back then, Japan's rise looked unstoppable. Its factories were lean and efficient. Its workforce was disciplined. Its companies didn't just compete, they dominated. Toyota and Honda humbled Detroit. Sony and Panasonic defined consumer electronics. Japanese banks became major players in global finance, and Japanese investors snapped up assets from New York to California. Japan wasn't just exporting goods, it was exporting a new model of industrial and financial success. And that's when alarms went off in Washington. The concern wasn't that Japan was winning at trade. The concern was that Japan was starting to challenge three pillars of American dominance at the same time: industrial production, financial center power, and currency leadership. An ally growing this powerful was no longer just an ally. It was a potential alternative core within the system. The response was subtle, and that subtlety is the lesson most people miss. In 1985, the Plaza Accord was signed. Officially, it was about weakening the US dollar. In reality, it rewired Japan's growth engine. The yen surged, appreciating by roughly 50% in a few years. Suddenly, Japanese exports were far more expensive. Margins were squeezed. The export model that had powered Japan's ascent lost its edge. Japan faced a choice: accept slower growth or stimulate domestic demand with cheap money. It chose stimulus. Interest rates were cut aggressively. Credit flooded the system. Asset prices exploded. Real estate in Tokyo became absurdly expensive. Stocks soared. On the surface, it looked like prosperity. Underneath, it was hollow. What followed was not collapse, but stagnation. When the bubble burst, Japan entered its long, grinding, lost decades. Growth didn't vanish. It just never returned to what it could have been. Leadership wasn't destroyed, it was quietly withdrawn. That is the template. If this framework resonates so far, take a moment to like and share this video. It helps get these deeper conversations in front of people who are trying to understand what's really going on beneath the headlines. China's rise follows a similar arc, but with higher stakes. Unlike Japan, China is not merely an ally operating comfortably inside the US-led order. It is a challenger with ambitions to reshape parts of that order. That makes the response firmer, but the mechanics are familiar. The message is the same. Growth is allowed. Reaching the center is not. The first tool is technology. Advanced semiconductors are not just commercial products, they are multipliers of power. Artificial intelligence, high-end manufacturing, defense systems, all of them depend on cutting-edge chips. By restricting access, the United States isn't stopping China from developing. It's preventing rapid leaps forward. This is a ceiling, not a wall. The second tool is capital. Chinese firms now face higher costs and greater friction when accessing global financial markets, especially in the US. Regulatory scrutiny, listing requirements, and political risk all translate into a higher cost of funding. Higher capital costs mean slower expansion and lower valuations over time. The third tool is indispensability. By shifting supply chains to places like Vietnam, Mexico, and India, the goal isn't to isolate China completely, it's to reduce dependency. When a country becomes less indispensable, its pricing power fades, and so does its influence. None of this causes dramatic crashes. Instead, it creates something far more effective: persistent suppression. Prices move sideways. Valuations remain low. Growth continues, but ambition is capped. Japan has already shown what that future looks like. At the same time, US assets often appear unusually strong, and this creates confusion. If the world is fragmenting, why do American markets keep rising? The answer lies in flows, not fundamentals. When uncertainty rises, global capital looks for safety, liquidity, and legal protection. Large funds don't ask where returns are highest. They ask where they can exit safely in a crisis. US markets still provide that better than anyone else. So money pours into the S&P 500, the NASDAQ, and a handful of mega-cap stocks. Prices rise not because profits are exploding, but because risk premiums fall. Safety itself becomes an asset. But this strength hides fragility. Market leadership narrows. A small group of giants carries entire indices. Beneath them, breadth weakens. When markets rise because there is nowhere else to go, they become vulnerable to shocks. Not from bad news, but from changing flows. Here's a question worth sitting with. Are markets strong because businesses are healthier, or because alternatives are weaker? The answer matters more than most investors realize. This is where many people make a mistake. They chase what looks strong without asking why it's strong. In periods of systemic transition, apparent strength is often a mirror image of weakness elsewhere. That kind of equilibrium never lasts. So how do you navigate an environment where headlines explain less and mechanics explain more? First, distinguish between price shocks and capacity shocks. A tariff might move prices temporarily. A technology ban limits growth for years. The Plaza Accord didn't crash Japan. It capped its future. Today's tech restrictions play a similar role for China. Second, watch the cost of capital. Growth lives and dies on cheap funding. When access tightens, ambition shrinks quietly. Valuations follow. Third, watch market concentration. When indices hit highs on the backs of a few indispensable companies, it signals hedging behavior, not broad confidence. These rallies can unwind faster than they build. If you've been thinking about how these power shifts show up in markets, I'd love to hear your perspective. Drop a comment below. Do you see more echoes of Japan, or do you think China's path will be fundamentally different? Stepping back, the pattern is remarkably consistent. The United States doesn't remove players from the board. It changes the rules of the game. Currency regimes, capital flows, technology access. These are the levers that shape outcomes over decades, not quarters. For Japan, the rule change came through exchange rates and finance. For China, it comes through chips, capital costs, and supply chains. The result is not collapse, but endurance under pressure. The question is not who wins, but who proves resilient. And resilience is built on fundamentals that rarely make headlines: stable energy, efficient production, deep financial markets, and institutional credibility. The US still holds advantages here, and those advantages attract time. Time bought through capital inflows and confidence. But history carries a warning. Systems that rely too heavily on asset inflation to buy time eventually pay for it, whether through volatility, stagnation, or adjustment. The real skill in this era is not prediction, it's interpretation. Understanding the mechanics beneath the noise allows you to see where pressure is building long before it shows up in prices. This is not a story about fear. It's a story about structure. And those who understand the structure are better prepared for whatever transformation comes next. If you found value in this breakdown, make sure to like the video, subscribe to the channel, and turn on the notification bell so you don't miss future deep dives like this. Thanks for watching, and I'll see you in the next one.